Bitcoin doesn't move randomly. It moves on a clock. And right now, in 2026, that clock is telling you something most investors are completely ignoring. Every 4 years, the same pattern plays out. The same euphoria at the top. The same panic at the bottom. The same regret from people who bought late and sold early. And every cycle, a new generation of investors swears this time is different. It rarely is. In the next 12 minutes, I'm showing you the Bitcoin 4-year cycle, THAMO, what causes it, and the 4 phases inside it, where we are right now, and the 3 metrics I watch every single week to position my portfolio ahead of the crowd. Edge crust. This is the framework that turned me from a reactive investor into someone who plays offense. Let's get into it. Let me start with the question nobody asks. Why does Bitcoin have a 4-year cycle in the first place? Stocks don't. Real estate doesn't. Gold doesn't. So why does Bitcoin have one so reliable that you can almost set your watch to it? The answer is something built into the Bitcoin code itself. It's called the halving. Every 210,000 blocks paraded, which works out to roughly every 4 years the reward miners receive for processing a Bitcoin transactions gets cut in half. When Bitcoin first launched in 2009, miners earned 50 Bitcoin per block. Then it dropped to 25. Then 12.5. Then 6.25. Then 3.125. And after the most recent halving in 2024, it dropped to 1.5625. Why does this matter? Simple supply and demand. The halving cuts the rate at which new Bitcoin enters circulation in half overnight. If demand remains constant, it stays the same, and supply suddenly drops by 50%, basic economics says the price has to go up. Not immediately, not in a straight line, but over the 12 to 18 months following each halving. Every single time so far in Bitcoin's history, the price has gone significantly higher. And this is what creates the 4-year cycle. Each halving kicks off a multi-year price wave. We can break that wave into 4 distinct phases. Phase 1 is accumulation. This is the boring phase. It happens right after the previous bear market has bottomed. The news is awful. People who got wrecked in the last cycle have left. But that's not the whole story. We're still here, building the future. Mainstream media has declared crypto dead again. This is when smart money starts. Think differently. Quietly buying. Not because they know what's coming, but because the math of the next halving is already on the calendar. Phase 2 is markup. This is when the halving has happened. The supply shock kicks in, and prices start grinding higher. Early in this phase, only the retail crowd is still skeptical. Bitcoin doubles, then triples, then people who pay attention notice. And casual investors say, I missed it, it's too expensive now. That's exactly what they said, and this pattern repeats at every previous bull run. By the late stage of markup, mainstream news starts covering crypto again. And people at family dinners ask you about Bitcoin. New retail money floods in. Phase 3, distribution. This is the dangerous phase. Prices are at all-time highs. Everyone is making money. New altcoins, moon every week. Influencers explode in popularity. And quietly, the smart money that bought during accumulation is selling TAG, distributing TAG to the new retail buyers who just discovered crypto. The energy feels unstoppable. The charts look vertical. This is the phase where new investors believe Bitcoin is going to $1 million next month. Phase 4 is decline. The peak hits, prices roll over. The first crash feels like a healthy correction, buy the dip. Then it gets worse. End of the bear market, Bitcoin has typically lost 70 to 85% of its value. The same people who said to the moon are now silent. Many quit. Many lose everything. And the cycle resets. The investors who survive the bear market with capital are the ones who buy during the next accumulation phase. The cycle begins again. So where are we right now? In April 2026, here's what the historical pattern suggests. The most recent halving happened in April 2024. Based on every prior cycle, the peak of the markup phase typically arrives 12 to 18 months after a halving. That puts the projected peak somewhere between April 2025 and October 2025. Which means if history repeats, we should already be in either late markup or early distribution right now. But I want to be honest with you about something. I don't know exactly where we are. Nobody does. I can't tell you Bitcoin will hit a specific price by a specific date. Anyone who tells you they can is selling you something. What I can tell you is that there are 3 specific metrics I watch every week that help me read the cycle in real time instead of guessing. Metric 1, Kate, Bitcoin dominance. This is the percentage of the total crypto market cap that belongs to Bitcoin. When dominance is high, say above 60% pen, when money is concentrated in Bitcoin and altcoins are weak. This usually happens early in cycles, when dominance starts dropping rapidly, falling below 50% pard, it means money is flowing out of Bitcoin into altcoins. That's classic late cycle behavior. Altcoin season historically peaks just before the entire market peaks. Metric 2, Ken, funding rates. This shows how much leverage traders are using on perpetual futures. When funding rates are extremely positive to you, meaning everyone is paying premiums to be long CLO, the market is completely overheated. Late cycle euphoria. When funding rates flip extremely negative TAM, everyone is paying to be short pan, that's a signal of panic, often near a bottom. I look at funding rates as This sounds technical, but it's just a way of measuring whether Bitcoin is overvalued or undervalued. Sentiment thermometer. They reveal what traders actually believe, not what they say. Metric 3, Pi MVRV Z-score.
Relative to its historical price range. When the Z-score is high, above 7 Bitcoin is statistically
very overheated. When it drops below 0 Caro, Bitcoin is statistically very cheap. Every previous bear market, bottom, and bull market top has happened at extreme readings on this metric. It's not perfect. But over a decade of cycles, it's been one of the most consistent signals there is. Now here's something most cycle videos won't say. The cycle might actually be changing this time. With Bitcoin ETFs absorbing huge amounts of supply, with institutions and corporations holding Bitcoin on balance sheets, with the regulatory environment shifting the perm, some analysts argue the classic 4-year cycle is becoming longer, smoother, less violent on both sides. Maybe the 85% crashes are over. Maybe peaks are extended. Maybe the entire pattern stretches. I'm not saying this is true, I'm saying it might be. And the right way to handle uncertainty isn't to bet everything on this time is different. Or this time is exactly the same. The right way is to stay positioned according to the framework CAM. Layer 1, 50% minimum, stablecoin reserves between 5 and 15%, rebalancing monthly tell, and adjust gradually as the data tells you what's actually happening. Here's how I personally use the cycle framework today. During accumulation, I increase my dollar cost averaging buys. The market is calm, prices are reasonable, nobody is excited, bobbly. That's exactly when I want to be buying. During markup, I let positions ride and don't add aggressively because price has already moved significantly. During distribution, I start scaling out HAD, taking small profits and rotating into stable coins. Not all at once, gradually. So if the top isn't in yet, I haven't sold too early. And if it is, I've protected meaningful capital. During decline, I stop selling and start buying again as prices fall the 10, but slowly, because bear markets last longer than people think. Notice what I'm not doing. I'm not trying to call the exact top. I'm not trying to call the exact bottom. I'm not all in or all out at any moment. I'm scaling based on probability. The cycle gives me the map. The metrics tell me roughly where I am on it. My portfolio framework tells me what to do at each location. This entire system, Tev, the cycle awareness, the metrics, map, metrics, and framework seamlessly together. The rebalancing rules to Pi took me a long time to put together on my own. Reading white papers, following analysts, making mistakes and learning from them. The thing that accelerated it most was being on part of a community where people much smarter than me were already tracking these metrics professionally and sharing their conclusions. The platform I use is linked in the description. They have Cycle, dashboards updated in real time, alerts when key thresholds get hit, and analyst commentary explaining what's happening as it happens. If you want to skip the years of self-education and have a head start, check it out. If you'd rather build the system yourself with free tools, PAF, TradingView, CryptoQuant, and Glassnode. CryptoQuant free tier, Glassnode Studio Calm, that path is also valid. Both work. Pick what fits your time. CryptoQuant free tier, Glassnode Studio Calm, that path is also valid. Both work. Pick what fits your time. In the next video, we're going to talk about the single biggest narrative driving crypto in 2026. This is the one. The intersection of AI and blockchain. There are real projects doing real work, and there are big projects that just slap AI on their white paper to pump the price. I'll show you exactly how to tell them apart. Because every cycle, the narrative that captures the imagination of the market makes some investors very rich, and other investors lose everything. And right now, AI plus crypto is DHE narrative. Subscribe and hit the bell. Drop your guess about where we are in the cycle in the comments, and I'll see you in the next one.